Welcome to Prep Nuggets CFA Level 1 course on equity investments. Before we get into equities, let's first gain an understanding of the organisation and structure of the financial market. In this first part, we learn what the functions of the financial system are. Let's begin. The participants in the financial system are primarily individuals, firms, and governments. The three main functions of the financial system are to help these participants achieve their purposes in using the financial system, determine the returns that equate the total supply of savings with the total demand for borrowing, and allocate capital to its most efficient uses. Let's examine each of these functions. Firstly, the goal of helping participants achieve their purposes in using the financial system. Some of these purposes are to save, borrow, issue equity capital, manage risks, exchange assets, and to utilize information. The financial system is best at fulfilling these roles when the markets are liquid, transaction costs are low, information is readily available, and when regulation ensures the execution of contracts. Let's go through each of these purposes, starting with savings. Individuals typically save for retirement and expect a return that compensates them for risk and the use of their money. Firms save a portion of their sales to fund future expenditures. Instruments used for saving include stocks, bonds, certificates of deposit, or real assets, such as real estate. Another very common purpose is to borrow. Individuals often borrow in order to buy a house, fund a college education, or for other purposes. Governments may borrow by issuing debt to fund their expenditures. Firms may borrow in order to finance capital expenditures and for other activities. Besides borrowing, firms can raise capital by issuing equity, where the capital providers become shareholders of the company and will share in any future profits. The financial system facilitates raising equity capital. Investment banks help with issuance, analysts value the equity, and reporting requirements and accounting standards ensure the production of meaningful financial disclosures. Many individuals, firms, and governments face financial risks that concern them. Such risks include changing interest rates, currency values, commodity values, and defaults on debt, among other things. Fortunately, these risks can often be managed by trading contracts that serve as hedges for the risks. For example, a wheat farmer and a flour producer both face risks related to the price of wheat. The farmer's risk is that prices will be lower than expected when his crop is ready for sale. The flour producer fears that prices will be higher than expected when he has to buy wheat in the future. They can both reduce their risks if they enter into a forward contract for the farmer to sell to the flour producer at a future date at a fixed price. As such, both parties are not subject to the market price of wheat for this batch. This removes uncertainty about future prices for both parties. The example we've discussed is an example of exchange of assets in the future. The farmer exchanges his wheat for cash in the future. People and companies often trade one asset for another for immediate delivery as well. This is known as spot market trading. While it is possible to trade directly with one another, it is more common and convenient to trade it in an organized market governed by the financial system. For example, Samsung pays its workers and suppliers in Korean won, but the company receives US dollars when it sells its products in the US. To convert the money from dollars to Korean won, the company trades in the foreign exchange markets. So we've seen an example of a participant who has an operational need to trade in the market. Not all market participants, however, have an operational need to trade in the financial market. There is a sizable segment whose motivation is mainly to profit from trading in the markets. They trade based on information that they believe allows them to predict future prices. Investors who can identify assets that are currently undervalued or overvalued in the market can earn extra returns from investing based on their information. And these are the 6 aspects that the financial system has to help the participants achieve their purposes. The second function of the financial system is to determine the rates of return or interest rates. It's interesting to view the financial system as two distinct activities, that of borrowing and that of lending. When a saver places money in a bank deposit, the saver is actually lending the money to the bank, which is the borrower in this case. When an investor purchases debt or equity securities issued by a government or company, the investor is the lender and the issuing entity collects the capital and becomes the borrower. When a bank issues a loan to a borrower, the bank becomes the lender in this case. This borrowing and lending can be viewed as demand and supply of money in the financial system. The demand and supply are highly affected by the rate of return or interest rates. When interest rates are high, lenders will want to lend more as the returns are higher, and the borrowers want to borrow less as the interest cost is high. As such, the supply of money will be high and the demand for money in the system will be low. Lenders may be driven to lower their rates of lending such that more borrowers will be enticed to borrow more. This drives the money supply down and the money demand up until an equilibrium level where the supply equals to the demand. This is known as the equilibrium interest rate, the rate at which the amount the borrowers desire is equal to the amount that the lenders desire. In many countries, the central bank plays an important role in guiding this equilibrium rate through monetary policy. This is covered under the economics portion of the CFA curriculum. Now, obviously not all the participants are going to borrow and lend at the same interest rate. The third function of the financial system is to facilitate capital allocation efficiency. As capital is limited, the financial system should be structured such that funds are allocated to uses that are most productive. In market-based economies, lenders determine directly or indirectly which borrower obtains capital. Borrowers who have better credit ratings are perceived as being less risky, so lenders with a lower risk appetite will be fine with lending even though the rate of return is lower. Conversely, borrowers with poorer credit ratings will have to offer higher returns to convince investors to lend to them. This process is efficient only if market information is accurate. The regulators and standard setting bodies have the responsibility to ensure that financial information is accurately reported in the most useful manner. And there you have it, the three key functions of the financial system. In the next lesson, we shall learn the classifications of financial assets and markets. See you again.